Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody, to another episode of Creating Wealth Simplified podcast. As I mentioned previously, we are going to start rebranding the podcast and getting excited about that. So as we continue to record new episodes, some of them will really start doing more deep diving into strictly just the note space and not just be only focused on kind of passive investing, but really just the passive and active side of things. So with that, today, I want to talk a little bit about an overview in the mortgage note industry and the fundamentals of mortgage note investing. And, people ask, a lot about note investing, and I have recorded many episodes in the past about what we do, but I just want to refresh people that we are a company, myself and several others that run a mortgage note fund. We've raised over $35 million. We look to create that win-win solutions for investors and borrowers. We not only experience in distressed mortgage notes, but just the investor journey. We're investors as well. We've been there, done that, over 5 funds. Our current offering through the Regulation A+ and Reg D allows for different investments into the same company. And really, we buy notes and we fix and flip them is what we like to say. I'll buy them at a discount, underwrite the loan, and then try and create that win-win, which unfortunately we can't do in every instance, but, is like anything in life, you win some and you lose some. So when people ask about mortgage note investing, we like to start at a very high level because you are not buying the property. You have the loan, and there are 2 types of loans that we can deal with, which are performing, where person's making their monthly payments, and then there's non-performing, where borrowers failed to meet their scheduled repayment obligations and the loan's in default. Now, interestingly enough, when people talk about defaulted loans, most people think the moment you miss a payment, someone's going to be knocking on your door and threatening to, rip you out of the house. Now, the average loan we see in default is default by several years. And, it gets the bad rap because I actually, saw this on Reddit, where somebody got served a lawsuit for a $1,000 credit card bill that they owed from like 10 years ago that was charged off and then sold. Now, charged off doesn't mean that you don't owe it anymore. It just means that the company's not trying to collect it. But, 15 years later, someone else comes and starts yelling and screaming at them, telling them they owe this more money, which A, gives a bad rep for the space, but also most likely they can't even collect on that debt and they're just trying to threaten the person. Which leads into, well, Chris, are you threatening people or calling them? Well, no. Then the question is, well, then how do you make your money? So let's kind of walk through how we make money. There's 2 paths that we can go down. We buy loans and just, typically at a discount. And then we have 2 strategies. We try and go through the borrower, which is negotiate the payment with the borrower. And if we can renegotiate a payment plan, we can generate cash flow from those payments. And then after getting that cash flow, we've got multiple options. We can sell the loan as a reperforming loan. Now, borrower may sell their home, which pays us off. Not seeing that as frequently today because they bought it, lower interest and now it's much higher. Or they have the equity and they just can't go anywhere. Or they do refinance, which I think when we see rates start to drop down again, we'll see more refinances and get us paid off. That's the perfect world scenario that we try for. The other is if the borrower's deceased or something, just can't work something out, we'll go through that foreclosure process. And if we have to foreclose, we'll either get sold at auction or we'll take ownership of the home. And then upon exit, we can sell the home. And people have asked in the past, do you typically sell as is or renovate? And in the past, we have typically just sold as is. Recently, we've been spending significant time with a firm that does a lot of, I'll call it traveling contracting. They're a traveling contractor. They actually flew to DC for a day, sat down, kind of gone through their business plan, what they do. And, some of these assets we might look now to, enhance them slightly to maximize value. Something we're considering. We're not, I'll say tied to it, but certain occasions that might be a better exit. So as we see more defaults coming down the pipeline, more properties in distress, investors not potentially buying as much, and people looking for that single family home, something we're looking into. So that's kind of high level, strategy within the note space, which it sounds easy, but how do you do it? How do you acquire stuff? What's your due diligence on something like this? If I want to invest with Seveney, what do you do behind the scenes to give me some confidence in that what you're doing? Which is a valid question. We are investors. We want to be able to answer that question. And when we invest in something, we want that question answered. So one is we try and target investments that have equity. So what do we mean by that? Buying properties that weren't newly originated mortgages, meaning, single family, somebody bought a house in 2023, they're in default. What does that look like? For us, we want something, it's 10 years old. Why? Because maybe that was a $250,000 or maybe it was a $100,000 property back then. Today it's worth $250,000. Property values typically have gone up over time. Your loan balance typically gone down. So let's say that loan balance is only $75,000 today. This is a 30% approximate loan to value. Now, if we're able to pick up that loan at 67 cents on the dollar, at 50 grand, we're at a 20% investment to value. We invested 50 secured by a $250,000 asset. So, we're not in the business to hit grand slams on every deal. We get singles and doubles. And we have a lot of people who will tell you, oh, your returns are only 8 to 10%. I can get 20% in a multifamily. You can, but just remember, when they have significant leverage just enhances the outcome. I've seen a lot of multifamily deals go bad, where that outcome is complete loss. You've seen some that win. Where does it end up at the end of the day? Pretty much, I bet you're pretty close to the same place we're at, just like all real estate investments, just like everything. Everything kind of reverts to a mean of 8 to 10%. Just a matter of, we like to define ourselves as going down the lazy river. You might like the roller coaster ride. That's completely up to you and your personal preference. So that's what we target. And we do that by buying loans, which people ask and want to understand the process, which is very similar to buying a house. There's a preliminary bid based off of a spreadsheet. So unlike trying to buy real estate, which you got to go look at it and then put offers in and just a lot of paperwork, we get a spreadsheet and we send an email back and say, hey, we want to bid 100,000 on this, basically, or keep it in Excel and copy and paste. And here's our bids. Much easier process and can be done from anywhere, which makes it so nice. Then, they may counter or accept, and there's still no paperwork signed. You might sign a letter of intent. Some will require it, but others don't. It's a, handshake business still, old school. Now, unfortunately, we just had 2 assets. We had under agreement. We even had under LOI. We're ready to close, and the seller pulled them because, quote unquote, the buyer says they're going to pay off the loan, which they've said 3 times. And I'm waiting for them to come back to us again and say, okay, we're ready for you to buy these now. And honestly, I'm going to give them the single finger salute because that's not how you should be doing business. Now, once you get them under agreement, there is that due diligence period. It's like an escrow period. It takes about 2 weeks to do your due diligence. And then after you're done your due diligence, you either accept it or you fade. Just like a property, hey, needs a new HVAC system. I'm going to deduct $10,000 from the property because of this. And you close. And the moment you close, you're the lender of the property. So you don't own it. You don't own the property. You're just a lender. So toilet breaks, roof leaks, not your problem. Just remember that. So you've gone through that process. And How do you know what's a good loan versus a bad loan? Is a question we get asked a lot. And people, any investment opportunity you go through, make sure you do your due diligence. We like to do what we call the 3 Ps, especially in note investing. But in any type of investing, this is relevant. A property, where is it located? What type of a location? What is the condition of that property? Notes, you also want to make sure you have clear title to the property. There's no outstanding taxes, liens, violations. You also want to understand what lien position are you in on that property? What's the value of the property? That's anything you invest in. You want to know the condition, structure, value. So we deep dive in the property, not only the physical property, but the chain of title of the property and make sure that is clean. Then the person. So any investment, you want to know who you're investing with. Same thing when buying a note. Who is this borrower that our servicing company is going to have to deal with? We will run what's called the skip trace, where we can see their criminal history, a little bit of their financial history. And then as part of the due diligence, we'll get to see their mortgage payment history. We'll see servicing notes, which will show the history and conversations throughout time. What's interesting is a lot of these borrowers think that that information doesn't transfer. And then they'll be like, oh, this old servicer told me this or this or this or this or this. And, we've been involved in some disputes back and forth where they didn't realize we had all that information. And then, ends up, they find out we do, then it changes the outcome significantly or how the process gets dealt with. We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at Seveney, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@seveneyinvestments.com to learn more. Thank you. And then, the predicament. In notes, non-performing, again, those servicing notes will give us, are they not paying because of death, divorce, job loss? Is what situation occurred? In any type of investment, it's the same thing. What is the purpose of the investment? What are you investing in? And based off of everything where do you think the outcome is going to run? It's good to understand the model, the pro forma. Are they using rosy colored glasses or are they being conservative? New sponsors always seem to do like best case scenario. For us, when we underwrite things, we don't underwrite best case scenario. We actually underwrite and buy based on worst case scenario. What does that mean? That means that we base it more on, a foreclosure, which if it forecloses, pretty much we think we know where that's going to end. But if we do better than that, and can work something out with the borrower, typically enhances those returns. So something to be important and understand, because when you're doing non-performing loans, there's a lot to manage, especially in that legal process, which starts by, sending a demand letter to the borrower, then having the servicer, try and work out a solution, seeing if we can get them on some type of payment plan. If we are, it's great. We can modify the loan, get 6 to 12 payments from them, and turn around and again, sell that back on that secondary market. If you can't, then we talked about, you go through that foreclosure process, could lead to what's called a deed in lieu, which is they give you title to the property. Sometimes a borrower may just sell that property or potentially, take it through foreclosure process. So things to understand. Now, some questions that get asked a lot as well, and things that I think people really need to understand on the passive side of things is, the differences between the types of investments. Is it something that's going to provide stable, I'll call it, I don't like to use the term predictable, but more consistent income? Or is it like you're getting paid once a year? Is there profit sharing potential, or is it just a straight return? We recently launched our newest fund that has profit sharing in it, which has been a huge success. So we're giving upside now to the investors. How is your asset correlated to other assets? For us, we're not correlated to the stock market. Job loss is typically what correlates most in note space. But I think that's the big differentiator is note funds will do better in more volatile times So if people are thinking in the next several years, there's more volatility in the markets, typically, again, buying non-performing stuff, volatility typically leads to that, which provides more opportunity. How are the returns risk adjusted? What does that look like from an investment standpoint? So how much leverage do they have? How much, what are they targeting? How does that look? And how passive do you have to be? Are you active or are you passive in that? And one of the things that we really talk to people about is, what's your team? Is it, internal or external? For us, we have a lot of vendors, external vendors that we use, servicing companies. But for example, investor relations, we do that in-house. Our own asset management, we do that in-house. So our accounting, we have an in-house accountant, but we have third-party auditors and tax returns and everything. But by being able to control all of that, we get our, financial reports done on time. We're not waiting on others to get that stuff done. We're already working, recording this, working with our auditors, get our audit done. So, a lot there that can be brought up in regards to, in-house for external. There's another, I'll call it a note fund, but they claim to be a note fund, but they didn't invest in notes. You're just receiving a note. On their website, they had different staff. They had CFOs and all these other people, which none of them actually work for the company. And the CFO, I think, was actually just like a bookkeeper. So, something to consider. There's another fund that we've seen recently that claims to have done, look this up because I was laughing when I saw this, because we received a pool of non-performing loans from 17 assets of theirs. And on their website, first, the individual in the fund has started real estate in 2020 and claims to have almost 800 units under management, 130 million in assets, and have done 125 full cycle deals. And I can tell you that with straight confidence is pretty much BS. On their portfolio, they've got these units I was looking at. They claim that there's 28 of them. They only owe 17. Every single one is in default. And not only is it in default, but they're like 3 million in default, and the property is only worth about 2. They've got another asset in Hawaii that is, they owe 15 million on. It's being foreclosed for 6 million. This company does not own nearly what they say they own on their website. They may have been a quote co-GP, but not even close. And, they are literally going under, but they're still out there raising money. So blows my mind. It's, one thing to, have bad deals and so forth, which we all have them. We've had some notes that haven't gone well and so forth, but we try and keep our information, of course, as accurate as possible. And I did some really deep due diligence on this company because they keep the same name for all their assets. They just add a tail to it. So it's XYZ Virginia, XYZ Maryland, or whatever case may be. And it frustrates me when I see people doing this type of thing. So, but I will get off kind of my proverbial high horse, I guess is the best way to say it, and get back into the crux at hand, which is, really start out talking about due diligence. But this is the stuff and the questions that people need to ask. And people, unfortunately, learn a lot of this too late. And, there's Alexi on LinkedIn. I can't pronounce his last name. It starts with a CHERN, but provides tons of great content out there. There's websites out there as well that you can learn about some of, passive opportunities and stuff, and people back and forth ask questions. I'm active a lot on Bigger Pockets. So just want to kind of share all of this information and just relay to people that, hey, now I'm going to, toot my own horn because we have our fund, and it's our note fund. And I think it is a opportunity people should take a look at, because where the current market conditions are, I think there's growing opportunities in the asset class that we're in. There's also a lot of continued demand for alternative investments within the space, and people moving away from traditional commercial real estate or multifamily, and getting that diverse portfolio, and also being able to what we do now, offering some profit sharing for a limited time to investors. It's not throughout, it's very limited for, the number of people until once it fills, it's gone. But, we want to provide people, the opportunities that are out there. If you want more information, go to seveneyinvestments.com. You can absolutely get more information about our offering. And if you're looking to be a little bit more active in the note space, again, feel free to reach out. But also this year, as we mentioned in the past, we're going to be sponsoring and managing and overseeing the Paper Source Convention, September 18th to 20th in the Phoenix area. So I hope you enjoyed this episode as, again, we continue to provide great information, content, and really start focusing more on the paper side of things. So thank you all. Enjoy and take care. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.